This video will look at government grants. This is money you get from the government. There are two types of grants. There's a revenue grant and there's a capital grant. Let's work down the revenue side first. These are for day-to-day operational costs and expenses. They're not for fixed asset purchases. Let's look at some examples of what they are. Let's look at the accounting treatment of revenue grants. They're treated as income, or they're used to offset the specific expenses. It's listed as other income, or it can be matched against the expense, and you referencing then the net cost of the item is shown. There's an example. You have an expense for wages for the year of 50,000. You get a wage grant, like a COVID support or something like that, or for some training, that's 10,000. You can either show wages of 40,000, that's the expense, which is net of the grant. Probably you'd have a note that would cover that, or probably a bit better is you have wages, show the expense of 50 under expenses, and then you look at government grant of 10,000, and that's under other income. And that's the treatment of the government grants on the income statement side of things. And just to wrap up on the revenue grants, there is no statement of financial position effect because they are expensed within the year. Okay, if they ran over the year, you'd have them as probably a deferred liability, but that we aren't going to be concerned with that. Okay, let's look at the capital grants. And capital grants are to help purchase or build fixed assets like buildings, machinery, or equipment. So if you were buying something like that, a car that would last for quite a while, that's what you'd use it for. So let's look at the differences. They're not recorded as income in full immediately. The grant is spread out over the useful life of the asset it helped to fund, and this is the matching principle. Okay, so let's look at the accounting treatment of it. Let's look at the accounting treatment of capital grants. Okay, so we have an asset costing 200 grand. Okay, so we're in the business of making performance cars, and they cost 200,000 to make, right? And the Irish government says we want to encourage this type of business, and we give you a grant of 50,000 towards it. Okay. The car is useful life of 5 years and no residual value at the end of it, and we get a grant received of 50,000. So the depreciation we work out on the car is very simple. We divide its cost by its lifetime and we get 40,000 per year. That's how much we depreciate that. And the grant income is 10,000 a year because it's literally 50 grand divided by 5 years. Yeah, and that's very simple. On the income statement, it's very simple. We have our depreciation expense because the car is getting worth less and less every single year, okay? And we get grant income of 10,000. And we show that as an expense under the expenses part, and this is an income under other income or grant income. And the net impact is an expense of 30,000. That's how it's recorded on the income statement. Very easy, okay? Let's have a look at the statement of financial position or the balance sheet. IAS 20, the standard says there are two approaches. There's the deferred income approach, which is the most common, and there you can net off the asset cost, which is less common. This means that you reduce the cost of the asset to 150 grand, which is your 200 minus your 50. That's one that we're not using, okay? The deferred income, very straightforward. The grant is shown as a deferred income under liabilities on the balance sheet. And the reason it's a liability is the business has a liability to earn the grant by providing the benefit of the fixed asset over its life. So you have the onus is on you, or the liability is there. Okay, and then let's look at the journal entries for this. Okay, quite straightforward. Okay, so when we receive it, okay, the money, the 50 grand, goes into the bank. Okay, so we say bank is 50k, 50,000. And then we have the liability on the statement of financial positions to balance that up. And that's 50, 1, 2, 3, 50. Okay, so that's it. So during each year, okay, the deferred government grant, we debit it, okay, So we debit it on the statement of financial position. So we have 50 in there. We debit it by taking 10 out. So it's 40 left. Okay. So we debit that, okay, by 10. Okay. Okay. And then we get grant income of 10K on the income statement. That 10K is recognized as income. Okay. At the end of the year, our liability is 40. Okay. There's your 40. Okay. And that's it.